Hello, everybody. Thank you so much for taking some time out of your busy days to join us. My name is Evan Levy. I am a director at Lido Advisors. And today we will be discussing working with concentrated positions. They got you here, but will they get you there? So really the topics we're going to discuss are why we believe it's important to diversify. And we're also going to provide you some ideas to create what we call a non-binary investment approach. And with an eye of reducing volatility and mitigating risk. So first things first, I'm going to go ahead and share our company's disclosures for a moment to satisfy our compliance requirement. So we'll leave that up there for 1 second. Terrific. And then before we dive into our conversation today, I'd like to take a moment to point out some of the features of our webinar. At the bottom of the screen, you will see a Q&A button. We encourage you to submit your questions as they come up throughout the presentation today. Your questions will be anonymous to the other participants, so you don't have to be shy, and we will reserve some time at the end to answer as many questions as we can that haven't been addressed throughout the presentation. If any questions occur to you after our presentation has concluded today, feel free to reach out to the speakers directly. At the end, we will be providing contact information, or we can all be found at lidoadvisors.com. So let me start by quickly introducing our company to some of those of you who are not as familiar. So Lido Advisors is a national wealth advisory firm headquartered in Los Angeles with office throughout the United States. We currently advise on over $9.25 billion of assets. Our experienced team uses cutting-edge strategies designed to grow, minimize, maximize, and protect high net worth clients, families, charitable foundations that we serve. And our investment discipline really focuses on reducing risk, increasing cash flow, and capitalizing on opportunities presented by constantly shifting markets and economic scenarios. So not just a set it and forget it type of shop. So now that we've got those out of the way, it's time to introduce our panelists. The first is Jason Osier, who is the president of Lido Advisors, and he has extensive experience working with high net worth clients and family offices and advising on strategies to protect, diversify, and reduce concentrated positions with extreme considerations to estate and tax concerns. Jeffrey Garden, he is our chief investment officer, and he is the architect of most of our cutting edge liquid investment strategies, including the cap and cushion option strategies that we've touched on in prior webinars, and we'll discuss more in context of concentrated positions today. And last but not least, my partner in the Great Pacific Northwest, Sean Moran. Sean is a vice president at Lido Advisors, and his base of operations is in Atlanta, Georgia. But Sean has nearly a decade of experience with deep stock and bond analysis and is very skilled at advising clients on strategies dealing with concentrated stock positions. So that is the team you'll be hearing from today. Hopefully we'll be able to provide you some good insight and some good ideas. So Jason and Jeff, before I ask you some more targeted questions, can you just give us a brief overview of the concept of protecting and diversifying concentrated stock and why it's so important when we look at, some of the most famous companies in the past?
Absolutely. Thanks, Evan. I thought I would first start off with the Dow Jones Industrial in 1979. Look at the list of these companies. And to Evan's earlier comment, it got you here, will it get you there? So when you look at some of these names, Allied Chemical, American Tobacco Company, I'm sure many of you remember Eastman Kodak, Exxon, General Motors, Sears, Standard Oil, Texaco. And when you look at the list of these 30 stocks, I'll ask one question. How many of these 30 stocks are still in the Dow Jones today? Any guesses? The answer is only 4. 3M, Chevron, IBM, and Procter & Gamble. What happened to a lot of these companies? Some of them no longer exist. Some of them are just simply out of the Dow. And again, going back to the original question or the original comment, it got you here, will it get you there? is really the answer and why we're presenting today on concentrated stocks. Let's show some real life examples. And we're going to play Name That Company. This company was founded back in 1871. It was the fourth largest investment bank in the world. And in February 2nd of 2007, it reached an all-time high. Anyone know what this is? Lehman Brothers. And you all know what happened. And so when you think about concentrated stock positions, Dick Fuld, the CEO of Lehman Brothers, at the time of the collapse, he had about 10.8 million shares of the stock, a value that at some point in time reached $930 million of value. And basically in over a year and a half, that $930 million of value basically evaporated. Jeff, you want to go to the next one?
Sure. So this is an oldie but goodie. It's one of the original Dow companies, founded in 1892. It was, as late as 2011, considered one of the most profitable companies on earth. The idea behind the the founding of this company was to take Thomas Edison's inventions and kind of aggregate them into one conglomerate. That's a big hint right there. Anybody have any idea what company this is? General Electric. General Electric's best day as a publicly traded company thus far was August 8th, 2000. And since then, it really has been a slow, painful grind downward. That's not to say that it hasn't had a couple of good years. It's not to say that people who have traded and invested intermittently over shorter periods of time haven't been able to make money on General Electric. But if you really just kind of bought it and held it since 2008, you've lost about 78% of your value.
And so some of the key takeaways, no company ever stays on top forever because the economies continually evolve. And sometimes it's a slow crawl like we saw with GE, and other times, unfortunately, it's just an absolute quick implosion like we saw with Lehman Brothers. And
the economy is constantly evolving. And like Jason showed in the first two slides there, only 13% of companies that were in the Dow, incidentally, that data comes, I was 21 days old when that picture of the Dow was taken, so to speak. Only 13% of those companies are still on the Dow Jones Industrial, which is supposed to represent, very broadly the U.S. economy. And then, even if you take it or slide it up to an even more recent period of time, over the past 12 years, 30% of Dow companies have been replaced. So, this is a constantly evolving and constantly changing environment. What was in favor 12 years ago clearly may not be in favor today. What was in favor 30 years ago is obviously far different than what it is today. And that, I think, highlights the importance of this topic.
And so really, how do you deal with, concentrated positions? And so really, we're going to talk about three different ways. Number one, diversification. That's very easy. Number two, there are exchange funds, but we're going to spend most of our time today on concentrated positions is talking about hedging around those individual positions.
Excellent. Thank you, Jason and Jeff. So before we start going into the different ways we do it, and we'll get to the diversification and the different ways that we want to, let's get some, just background from what you guys have seen as part of your experience, because really why we're having this webinar is the fact that so many of our clients have done so well over the many years with one or two stocks that have become an outsized portion of their portfolio. 50, 60, 70, even 100% of their overall wealth, which could also be substantial. So maybe Jason, without divulging anything confidential, can you provide us some context of your experience with working with families that have large concentrated stock positions?
Yeah, I was hired in 1999 to run a $3 billion family office, and he had just received a very large chunk of stock from an individual company. And I remember having the conversation around hedging, and he was very smart. This gentleman, the patriarch of the family, he negotiated in a put right on a particular company right after it went IPO, and he really didn't even wait any time to exercise the put option. He was not concerned with paying the taxes because he knew having 75% of his net worth tied up in one stock was not prudent. And it IPO'd at 19. His put right was basically at 19. Stock jumped up to 24. He exercised his put right. And sure enough, when you look 3-4 years later, that stock was no longer in business. And this was a 10-figure liquidity event. There was another family that I knew about in the early 2000s that didn't want to sell the stock that made the family wealthy. And so what did they do? They borrowed against the stock. They made investments. And in 2008, not only did the investments they make go down in value significantly, that stock that they borrowed off of basically almost went down to zero, and it was a double whammy. And so, there's a lot of success stories out there, but there's also a lot of stories that really cause concern and make the argument for either diversification, exchange funds, or hedging.
Sorry, we have the little work at home security dog barking.
Somebody agrees with me, Evan.
Yeah, I'm sorry. I'll try to talk over that. Go in the other room, March. Anyway, so a little opening into all of our lives these days. So Jason, even though you have these families who really made their money via concentrated positions, sort of what's the mindset of just generally, how much you could really afford to lose in a concentrated position? What makes sense for each family, because that concentrated position is generally what got them there. Why is it so important to maybe take some off the table?
Yeah, I mean, there's no right or wrong answer as to what is the appropriate amount to have in an individual stock. It really depends on the individual family's circumstances. And so, just throwing out some random examples, you have a family that might have $8 million in an individual company and they have $12 million outside of that company. Real question is, what are they spending per year? If they're spending $300,000 per year or $400,000 per year, it really isn't going to move the needle either way, whether they sell all the 8 million or some of the 8 million. Now, a particular family who has 80% of their net worth tied up in one stock, and let's say it's a $10 million family and they're spending $400,000 or $500,000 a year to maintain the lifestyle. That might be a situation when you really peel the onion, you might want to sell some of that stock. So every family has different needs and wants and desires. The answer is shouldn't be extreme. You shouldn't sell all of it, nor should you have 100% of your net worth tied up in that one stock.
Great. And also now to play a little devil's advocate on the side of people who have a lot of actually personal ties to the companies that they're invested in. For instance, Sean and I work with a lot of people in the Pacific Northwest who have a lot of Google or Amazon or Microsoft. They believe in those companies. They see it on a day-to-day basis. That's what brought them to their, that's what brought them there. How do you advise and how do you talk to clients around, over time, creating a diversification with when they say, which is a realistic concern, is, why should I sell, have to pay taxes on it just to diversify into something that may not be as, high octane as an Amazon or a Google or a Microsoft, as an Apple? As a former CPA, you used to deal with all of these tax concerns. How do you manage your way around that?
Yeah, I mean, look, we're going to spend a lot of time in a few minutes talking about hedging when you don't have to sell the position and pay taxes. But, look, at the end of the day, we're all driven by fear and greed, right? And the most natural reaction when you talk to a lot of these families about the concentrated position, it's really FOMO. It's the fear of missing out. And, you can make a recommendation. I think you should sell a quarter of it or half. And, it's really difficult because it's an emotional decision. That's the stock that really got them there. And they still believe it's going to get them, there, as Evan says. And so, it's really navigating, through the emotions more so than the math behind the taxation.
No, that's a great answer. And so now going to Jeff Garden, a little bit of the same question that I asked Jason, but also, another question to follow up on this is, is there a number that you look at, that makes you a little uncomfortable? Maybe it's stock dependent, maybe it's overall concentration, where you reach out and say, hey, advisor, I'm looking at this portfolio and there's just way too much of this position. We need to talk to the client about doing something.
It's a great question, and it's a professional dilemma, frankly. How much is too much? When do we kind of make it a point to be a little firmer in terms of sell or hedge or exchange or whatnot? I could even say that from company to company, or even within the same company from decade to decade, that answer changes. Microsoft, case in point, Microsoft was a snooze for a long time. There was really not much happening with that stock for decades. A little bit of change in management, and it's turned into rocket fuel. But there was a long period of time where, whatever, keep it, sell it, doesn't matter. Now, it requires thought, and the way I generally like to do these things, I like to put a number to it. Evan has probably told all of our viewers how data-driven and how research-oriented our firm is. And really the way I like to do it is I like to put something tangible on it. I like to put a number to it. And then I like to kind of present our teams, our advisors with the data. Okay, so if you keep this amount of this stock, diversify the rest, given our current assumptions and given the basket and the portfolio that you've constructed around it, this is what you can expect in an extreme environment. You do this amount, this is what you can expect. You do that amount, this is what you can expect. There's no right or wrong answer. Really, at that point, it's Evan's job to go back to the clients and ask, what are you okay with? What do you feel comfortable with? 30% drop it down may not be a big deal for you. For other people, a 15% drawdown may be a very, very, very big deal. And as a result, we need to tailor ourselves to your goals and your constraints and just provide solutions.
Great. And that's exactly right. Everyone is different. That's why we do things on a custom basis. We don't have model portfolios because each client does have a different risk tolerance and different assumptions of what they're willing to lose or how a little bit may affect their lives or a lot of it. Kind of staying on that sort of idea, Jeff, a lot of, going back to the question I asked Jason with, people that have Microsoft and Google and Amazon because they believe so much in it because they work there. When you're trying to create a portfolio of stocks, for instance, and baskets of stocks, how do you counterbalance that, knowing that the client's always going to want that home run, hey, put more in the high flying ones and less in the ones that are going to be maybe a little more boring, but possibly stable over time, to preparing something that as a chief investment officer for such a large AUM, it's your responsibility to maintain a good strategy.
So there's a couple of approaches here, and there's a couple of things that need to kind of happen at the same time. Number one, when my team and I create strategies, when we put together portfolios, when we go through the process, even whether it's actually managing the strategies or creating the tools that teams out in the field like Evan and Sean use to allocate your portfolios, it is in everyone's best interest that we not be thinking about any individual. We want to be as objective and as data-driven as possible. So, you know, that type of thinking is really what has to go into the process. Now, that being said, we are aware of the fact that, you know, as important as strategic asset allocation is, and as important as diversification is, you know, it's about as boring and as uninteresting to clients as it is important. And, you know, there is, in our view, there is nothing wrong with speculation. There is nothing wrong with going out and taking some amount of money and investing in stocks that you really believe in, investing in things that you know, in ideas that you really believe, whether it's, you know, we have a client that was a big believer in Weight Watchers. Not in any of my portfolios. You know, I haven't found anything interesting about it, but go right ahead. You know, as long as it's not going to impact your life, as long as you're not going to have to change, you know, your living conditions, if that doesn't work out, have a ball, have fun. We're happy to get on the phone and talk to you also. That, I mean, we love this stuff. That's what we do. We're happy to talk stock. Just make sure it doesn't impact your life.
Yeah, and I think that's the key. And now I can ask my my partner Sean to go off mute and make sure he's still awake. Even though I see his eyes are open, so that's a good sign. But Sean, we come across concentrated positions a lot, especially because we cover the Pacific Northwest, and there's so many people who have done so well in the tech stocks. What do you generally, you know, first I'll ask you, what do you generally see lately when it comes to, you know, prospects or clients coming to us with concentrated positions? And then I'll really start asking you the sort of next question is, both Jason and Jeff have said pretty clearly, it depends on the individual situation. It depends on what they do. How do you illustrate to them the importance of diversification without just telling them?
Thank you, Evan. And yes, I am still here. And we actually just received a question from somebody with a Microsoft concentration. So as a little background, Evan and I are two of Lido's concentrated stock specialists. And we spend a lot of time, and we spent countless hours and days building out custom solutions for clients. And it all starts with what's most important to the client. Is it reaching retirement by a certain date? Is it funding a child's college education? Whatever's most important for the client, we reverse engineer a solution for them and give them our best guidance on what we should do to tackle the good concentrated stock problem. And when we call it the good concentrated stock problem, whether it's Microsoft or Apple or Amazon or Google, or I'm based in Atlanta, Coca-Cola, you name the company, we're in a 13-year bull market run, where if you've worked for some of those companies for the last decade plus and keep buying more and more of those shares and receive restricted stock and really build your wealth that way, you wake up in your 40s or your 50s and you realize you have $2 million or $5 million or $15 million. And in some cases, 80 or 90% of your wealth is in one specific stock. So Evan and I, in this environment, we run across it all the time. And we're in a time period where a lot of investors are candidly pretty greedy in terms of human emotion naturally says, this stock has gone up so well over the last decade, it'll continue to go up, it'll continue funding my lifestyle. Well, what we've seen in this environment is some people that had $2 million a year ago now have $5 million, or in some rare cases, $10 million by holding concentrations in some of those names that we see on CNBC on a regular basis. So when you build that concentration, the issue we see is how do you get from point A to point B with extreme tax efficiency? And on paper, you have the profit. If you want to turn that into, you know, college education for your children or a new vacation home or whatever you might like, you have the tax liability to tackle. So in this environment, you know the company so well. So how do we get you from point A to point B? And it comes down to, at Lido, I call it the trilogy for concentrated stock. It's protection, which Jeff will talk about here in a minute. It's work towards diversification. And when we see diversification on this page, a lot of people will say, hey, sell stocks, add to bonds. Well, bonds in this environment are losing to inflation for the most part. So how do we diversify and stay on the offensive? Because if you have a concentration in a technology name, it's not exactly exciting to sell Tesla and buy bonds paying 1 to 2%. So how do we stay on the offensive? And then how do we do all of that with extreme tax efficiency? So that's just a taste for the environment we're in today and how we build solutions around it.
Great. And how do you, and what's the process you take to show the clients sort of, where they are, how they can get to, how they can get to their goals, really what we call what's their why? Why are they working this hard? Why do they want this money? How do you illustrate to them, by maybe even taking some risk off the table, you can get to where you want to be?
And that's a great question, Evan. We customize every solution based on what's most important to the client. Are you 45 years old and you'd like to retire at age 50? Well, we might have a quicker process for trying to divest, protect, and diversify that position. So within the planning component around the concentrated stock, it's understanding what's most important to the client and bringing together 4 different areas of wealth management so that everything's working in tandem together. So it's making sure the estate's in place, as Jason alluded to, making sure that it's positioned to whatever you want to happen to these assets will ensure that your estate plan is set up that way. It's taxes. We can't give you guidance on how much to realize in gains in a concentrated stock unless we have a full grasp of your tax situation. And so that's why we've got in-house CPAs and tax specialists to provide that guidance when we build custom plans for clients. And then it's the financial plan as well. Evan, we've run countless financial plans where if somebody has X, we know they want to spend X in retirement. And through running financial planning software, we know that they need maybe a 6% return or a 7% return. So how do we build a custom solution for them and really narrow the range of outcomes within the portfolio? And when you narrow the range of outcomes within the portfolio, you narrow the range of outcomes within when and how successfully somebody can retire. So when you bring together the estate, the tax, and the financial planning, organically, the investment solution is understood. And to address the question from somebody in the webinar today, how much should you keep in Microsoft? Well, it's specific to you. It's specific to what's most important to you. For some clients, it might be 10%. For some clients, it might be 40%. We build out the solution for the client and bring them our best ideas.
Yeah, thank you, Sean, for that. And just really, and we've seen it together, and we've seen it. There may be even some clients on the call who've gone through this exercise with us. Hopefully there are, but just a few recent anecdotal experiences with showing the power of planning with concentrated positions. We go through this process with what we call our secret weapon, Mike Burke, who's in charge of our planning team. And he puts together really a comprehensive plan that shows simulations based on expenses, what you could expect in life events, Social Security, whatever life may throw at us. And it will show them, more oftentimes than not, that they're going to end up with more money than they may have thought at the end of their lives. And when I say more money than they thought, more money than they can spend, more money than they thought they would leave for a legacy, more money for charity, whatever their why is, as we say. And then we look and say, well, if we're doing that with a fairly conservative sort of efficient frontier model, not taking only the best years into account, but taking volatile years into account too, and we can reach your goals with less friction and less risk. Concentrated positions could be one of the main reasons that you have to start over, or you don't get those goals because you're putting all of your eggs in one basket. And sure, let's say your goal is to have $10 million, and we run a plan for you and it shows that you can have $12 million if things on a median basis work out based on the simulations. But yeah, sure, if you held that extra Microsoft or held that extra Google or Amazon, and there happens to be an increase, you may have $20 million, but you could also have half of that or less if you're putting your eggs in one basket. So if we can get you to your goal, or you can reach your goal with taking the least amount of risk possible, why not
Did we lose Evan's sound?
I think we lost, yeah, I think we lost Evan's sound. And I think that's a good segue until we get Evan's sound back to talk about hedging. And this is where we're gonna run through some options. And I see one question that came in while Evan was talking. It says, how do you create value with diversification? So assume someone has Microsoft stock, which is producing about a 15 to 20% return in today's market. How do you structure your solutions, which provides maybe not the same return as Microsoft, but something close? And we're going to talk about examples exactly addressing that question, where you'll still get upside on the individual stock, but more importantly, we can build in, we'll call it earthquake insurance on the way down. So I'm going to switch to this, Jeff, and let you start talking about some of the different solutions.
All right. So, when we're talking about hedging, there's a number of different approaches that we can take. The first and really the most basic approach is what we call a protective put. A protective put is very, 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 very similar to buying insurance. In fact, it is buying insurance. It costs a certain premium, and between a certain price and a certain set price agreed upon in a contract, you're exposed. That's a lot like a deductible. And then beyond that price, you are fully or partially protected depending on your policy. Okay, so a protective put, in our example, we went ahead and we bought the June 16, 2023 110 strike. We paid $14.25 for it. And as long as this stock remains above 110, my upside isn't capped. I'm not going to lose any money as a result of me placing this trade if the stock keeps going up. Now, net, as you guys can see from the gain in the stock versus the gain in the position, I'm not one for one with the market. I have to pay my premium, and my premium here costs $14.25 a share. That is kind of expensive for some people. For other people, it's worth it. So that is the most basic and most straightforward hedge out there for a concentrated position. Now, keep in mind, if the stock goes down, if I reach 110, if the stock market or if the stock itself reaches 100, there's a few things that are going to happen. Number one, I'm going to need to either deliver my stock to the person who or entity that sold me this insurance, or I'm going to need to sell that policy before it expires. This is a long position. So we're going to need to sell that policy before it expires, one or the other. So the advantages here, very simple. I keep my dividend. I keep my stock. I have to pay a premium. I have very, very limited downside because I cannot really lose money as long as the stock, as long as the stock is at 110 or lower. So below 110, I'm not going to lose $1. And I have unlimited upside. It doesn't matter how far up the stock runs during the time where this policy is running. I don't lose. I have unlimited upside. I am not capped at all. Let's go to the next one. All right. Well, like we said, $14.25 a share, that could be pretty expensive. That a lot of people may look at that and say that is quite the premium to pay for an insurance policy. Not sure I'm interested. So what we can do is we can create a limited insurance policy, something where the terms are a little bit tighter, where you don't necessarily have 100% protection below a certain price. And in this trade, this is what we call a put spread. In this trade, you're going to be protected between a certain range. Okay, so if the stock, once again, if we're going to use 115 and 95 here, if the stock goes up from wherever it is today, I'm not worried about it. Once again, I have no cap on my upside. I still pay a premium, but a much smaller premium. Okay, this time I only pay $5.90. And as a result, my gain is a lot closer to that of my gain if the stock simply went up and was not hedged. However, to the downside, once I reach 115, my protection kicks in. My protection is really only good though through 95. Okay, so I'll always have that little gap here. See the stock can continue to go down. I'll always have that little delta. I'll always have that kind of cushion that will put me in a better position than the stock no matter what to the downside. But it's not like the protective put where beyond a certain point, I don't lose any more money. So once again, we keep the stock, we keep our dividend, we pay a lower premium, we reduce downside within a certain range, and our upside is still unlimited. Let's move on. Okay, this is what we call a collar. And in a collar, really price is a primary concern. So we want to make this as close to zero cost as possible. And the range that we let the stock play in is really what determines where we buy and sell our options. So in this case, we're going to buy 110 puts. Okay, and we're going to pay $14.25 for those, but this time we're going to sell away our upside beyond 140. Okay, and we're going to receive $14.90 in compensation for selling away our upside at 140.
And Jeff,
Okay,
let me add one comment, because I think this slide really answers the question that was asked on Microsoft. If I wanted to still make 15 to 20%, and on this particular case, you're capped out at 12.5, and the most you're going to lose is 11. We've created a box. Now,
Correct.
The best part about this is the functionality. We can sit down with you and we can structure this where you want 15%. Okay, if you want to go up to 15% on the upside, maybe your downside goes from -11 to -15.
Correct.
And so the functionality here is really something that we can sit down and design specifically for you. Now, another thing we can do with a collar is we can create almost the perfect hedge, where maybe the most you can make is 5% and the most you can lose is 5%. And in that scenario, what we can do is, with our relationship with Fidelity, we can borrow off of that stock and then create the diversification around the stock without having to sell it.
Correct. So what Jason is talking to you guys about is a very well-known kind of formula in the finance world. It's called put call parity. And that basically, you know, for our purposes, what it basically says that if I create a perfect hedge, meaning I create a collar that is not only costless, but it's right on top of where the stock is trading today, effectively, what I'm going to get is a U.S. Treasury. All right, that's the outcome. U.S. Treasury, which is very, very safe and pays me very, very little interest, but I can use to margin very safely and create a diversified portfolio. So to answer your question, I can take this position, I can create a collar much like this one. It doesn't have to be as close as Jason is describing. I can create this kind of collar where I'm still getting 12% to the upside and have 11% exposure to the downside. And then I can take a significant amount of my money because I've mitigated a lot of my risk here. I can take a significant amount of money and I can invest that in a diversified portfolio. I can create different types of structures using this as my collateral. This is a very, very useful and very, very simple tool. And we use it a lot here. Lots of times, some of our most effective trades are simply creating this structure and then adding one more option position. And, you know, we're going to see that right now.
Yep.
So with a collar, again, well, let's go back real quick. With a collar, you know, we're buying a put, we're selling a call, and that's going to hedge our stock. We maintain our exposure between a certain range. We've put the stock in a box, so to speak. We keep our dividends. We can diversify should we choose to, and if we do this properly, it does defer taxes, but you need to be careful because unwinding may have a cost. Okay, and it doesn't really matter, and that's kind of the big secret here, I guess, but it doesn't really matter what option strategy you use. Unwinding may have a cost. Even in a protective put, if your stock goes down and you don't want to execute, you don't want to exercise your stock, fine. You're going to sell your put, and your put's going to be at a gain, and you're going to be paying taxes. That's life. Or you're going to lose your stock, you know, because it'll get put to somebody else. There are no free lunches. And that's very, very important to say. There are no free lunches. We can mitigate, we can defer, we can get very, 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 very creative. But in the end, what's due is due.
And speaking of creative, Jeff, I mean, one of the trades that is actually my favorite that you've created is this gap trade. And just before we talk about the mechanics of the trade, I like this trade a lot because you, as the owner of the stock, you're going to get 1-to-1 on the upside of Apple. So if Apple's up 16, you're up 16. If Apple's up 20, you're up 20. The most you can make for this period of time is 20%, because if Apple's up 28, you're up 20. So you've given up that upside, but more importantly, you can see here, the most you're going to lose is 3.62% on that stock, even when that stock is down 35%. Once it goes past minus 35%, you can see you're going to start going down with that stock 1-to-1, but you're always going to be about 32% ahead of the losses on that individual stock once it breaches 35%. We call it the cap and gap trade. And we can do this on individual stocks. As you can see, we're doing this on Apple.
Correct. We've done, I think, hundreds of these on Microsoft. We've done hundreds on Google. If there's an active options market, we can do this. And as you can kind of see, if you kind of take a look at the transactions, this is nothing more than a collar with another short put. That's really all it is. All right. So we have our stock. Okay, we keep that. Here we go. We are going to sell a put. We're going to buy a put, and we're going to sell a call. And then we're just going to sell another put. And that's how we create this trade. And the nice thing about this is, again, we're going to participate in a significant amount of upside if the stock rises over the period of the trade. And we could do this for as little as 9 months. And we can do this for as long as 2.5 years sometimes, depending on the options market and what a client is looking for. These are designed and algorithmically created to account for the probability of a particular decline in the stock. All right. So the reason that Jason pointed out 35% is because our system has basically said this is the area of least likelihood. This is where if you place your hedges and if you place your protection in this area, this is where you're most likely to succeed. A decline beyond this is not as likely. And as a result, that's kind of how we create this. Same thing to the upside. If it's not what we would consider equity-like return, also, it's a computer that does the math for us. Equity-like returns, if it's not something that is a reasonable rate of return from a particular stock over a specified period of time, we're not going to do the trade. The computer will literally tell us, look somewhere else. And that's
Jeff, a
how
few
this
things.
works.
Am I working again?
Yes, you are.
Yeah, so besides dogs and microphones cutting out, this has been pretty smooth. So just a couple things just to point out with this trade and all the option trades, because I think it's important to know. So with all the option trades, and we should be advising the people who do it on it, when you're doing it, for the most part, you should be expecting to have to deliver your stock if it goes outside those ranges. Again, there's ways to buy it back. You may have to spend some money to it. So it's very important that anytime you're working with your advisor to understand that, you know, at what points do I actually deliver, in this case, whatever portion of my apple that I'm exposing to this. And in this case, you know, Jeff, what would that be? At what situations on this chart would you be selling the actual apples?
Look, you would be selling the apple here effectively at $120 to the downside and at $150 to the upside. And then, quick caveat, you'd be buying it back at 80. Be that as it may, and that is always a risk. A couple of things to keep in mind. There is a big difference between something that is your option and something that is somebody else's option. Okay, so when I buy this put here at 120, that's my option. I decide whether to exercise it or not. I'm not really at risk here. I can decide to sell it. I could decide to exercise it. That's my call. It's when we have these sells that were in somebody else's hands effectively. And that's something that we prepare for and we notify everyone about and make sure that, you know, we avoid scenarios that frankly, nobody wants to be involved in. That's the trick here. So, you know, if the stock goes above 150, you know, in a trade like this, Evan will be told, listen, you have an option that's deep in the money. You know, get on the phone with your client, figure out what you guys want to do, so we don't have any issues. The other side of the coin is, hey, Evan, we're way past 150. We're down to $80 on this stock. What do you know, you're gonna be in a position where it gets flattened out. So your client needs to prepare for certain tax consequences and then getting the stock back at 80. Maybe we want to close this out. Maybe we want to do something else. It's a conversation, and that's really what all this is.
So yeah, so it's key that some of the points that Jeff is bringing up, these are not just set it and forget it trades that we wait until the expiration of it and just let it roll. We're constantly monitoring it, one. Two, also, this is not for all of a concentrated position, because when the market goes up, when your stock goes up, you are giving up opportunity risk. You know, in this scenario, you know, let's say Apple did get to 185, you'd be giving up essentially 28% of the upside of Apple in this position. The idea is to create, as they talked about with the other trades, more of a box, more of a range of outcomes where we know that, hey, if we can still get 20%, it doesn't change your overall why. It still gets you to the point. And it also takes care of a more structured diversification process. So we're not just selling, we're still squeezing out some more upside potential. We're doing it over different tax years, which is very important. So we're being very tax conscious about this. And then we would expect you, if you have a large enough concentration, to be holding, you know, let's say it's Microsoft and Apple, a significant portion outside of Leidos management that's not accruing a fee, that if the market goes up, it still keeps riding it up and you get all that upside. But if it goes down, you have the protection here. And again, it goes to that non-binary side where it's not you win or you lose. If Microsoft or Apple goes down, you win or you can win. So we are getting a little short on time. We have a lot of questions coming in. There's some really good questions. I want to sort of now turn it over really quick to Sean for a question of, okay, now we have diversified, or now that we've sold some of the stock. Let's say I'm fine with Apple getting called. I now have a couple $100,000 of proceeds from that after taxes. What do I do with it? How do I diversify?
So Evan, the question becomes, when you're at point A and trying to get to point B with tax efficiency, what do you diversify into over time? And it comes back to, what is the client looking to achieve? Do we need to generate more income so that the client can maintain their lifestyle in retirement? Do they have a long runway ahead of them? Do we want to still be aggressive? We've got a long list of strategies we can implement for clients to customize a solution for them. One specific idea is a qualified opportunity zone investment, where we could talk about this investment for a long time. It's basically a way to diversify into developmental real estate that we think is a great long-term investment, and it comes with extreme tax benefits. So in summary, for the tax benefits, you can take capital gains realized from a concentrated position and invest them into a qualified opportunity zone fund. Any tax liability from that capital gain is actually deferred to 2026. So call it 5 years from now. So you receive the benefit of being able to invest that full capital gain, not pay taxes, and earn a return for the next 5 years, which is great time value of money investing. That tax liability in 2026 is then reduced by a 10% discount. So if you invested $200,000 in gains in 2020, 2021, the tax liability is due in 2026. You would then owe taxes on $180,000, $200,000 capital gain minus the 10% discount. That's not even the best part. Any capital gain invested in the fund, if held for at least 10 years, grows entirely tax-free if held for at least 10 years, and it's required by government law to be held for at least 10 years. That entire growth over the 10+ year period is tax exempt. So if $200,000 grows to $400,000 11 years from now, that entire $200,000 gain is entirely tax exempt. So it's a great tax strategy, and it's a great way to diversify away from stocks at current valuations into developmental real estate that we think is a strong long-term play. And so that's just one idea of the long list of strategies we have at Lido, and specifically looking at alternatives, really diversifying the portfolio without compromising returns or staying on the offensive, as we mentioned. So we do a lot in the, we've got access to hedge funds, we've got access to equity on real estate, we've got access to debt on real estate, and really build out a better diversification strategy so that a client can have an all-weather portfolio and meet their goals and objectives.
Great, Sean. Thank you for that. And just as a quick note, so for all of those private investments, the non-correlated assets and real estate, for those, the clients are subject to being accredited or qualified investor statuses. So it varies on it, but it really does offer true non-correlated diversification. Well, guys, Jeff, Jason, Sean, thank you so much for your insights. We're going to sort of turn it over for some Q&A right now. There's been a lot of questions that have come in. Again, please feel free to contact us if we didn't ask you to answer your question, or if we haven't had an opportunity or thought comes into your head after it. So just looking through the questions, and I'll sort of just open it up to anyone on the panel who wants to answer. So one of the questions on the cap and cushion or the option strategies for the underlying stock, someone asked, can they sell a portion or the entire holding at any time without penalties?
Can you sell a portion of the stock at any time without penalties? Well, without penalties on the options or without penalties on the stock? Well, let's answer both. So the stock is going to go up and it's going to go down as the stock goes up and goes down with the market. The decision to sell that a portion of that stock When it's hedged is not something that is it's just not something you do without some significant thought. Okay, so options work both on the intrinsic value of the stock and on time. Okay, so as long as there's time left in the life of the option, there is some chance, high, low, somewhere in between, some chance that something would happen and an option would be in the money or out of the money. And as a result, they're always going to have a little bit of what we call time value, regardless of where they're trading, as long as there's time left. Okay, so I would say the further out of the money your option is, meaning the further away the stock's price is from the agreed upon price of your options contract, the further out of the money you are, the less of an issue that is. But at the same time, the further out of the money you are, the easier it's going to be for you to just say, you know what, let's just close out the option too, at which point you're basically free and clear to do whatever you want. So there really is some nuance there, and it really is going to depend on a scenario. Why do we need to sell? Why are we looking to sell? What's our alternative? And these are all conversations that we would have. And if there is a way to, and these could get very, very involved sometimes, but if there's a way to add another overlay on top of your overlay that allows you to do what you want without any kind of risk or with minimal risk, we can do that too. And we've done that for clients many times. So there are solutions, there are answers. Creativity is the name of the game, and it's our favorite. It's the best part of my job. But it is possible. It just depends.
And so the next question, which I'll sort of sum up an amalgamation of a number of questions that sort of get to this, I think, point is, okay, now that we've reduced, X stock, we still want the proceeds to be invested in the stock market, let's say, not necessarily into the real estate or other things. How do you guys as an investment team try to reduce the correlation then to other stocks when creating a stock strategy?
That's actually very, very easy. Believe it or not, that is, you could just go back to the collar, and you can take that collar and you can just basically treat it as a very, very, very safe piece of collateral and build a diversified portfolio off of it. If I take it a step further, I don't even need to buy any stocks to do that. I could just do that with S&P 500 options, using that hedged position of Apple or Microsoft or whatever it may be, to create a structure that is probably even more favorable to you as a client, as an investor, than it would be to just buy the stock. Now, again, there's always drawbacks. There's no free lunch. Those are words that we live by in this business. You're limited in terms of time. When I just buy stock, I can let them ride and let them run for decades if I want. Whereas an option comes to an end at some point. And there's taxes and transactions that, need to be accounted for. So again, very, very situationally dependent, but diversifying the portfolio is the easy part, because we're an RIA. We manage diversified strategies. That's what we do. So that's, we've got that down. The added value here is really in how we protect you and how we put you in a situation to meet your financial needs, regardless of whether you want to sell your stock or keep it. let's just find a solution. Let's just find a way to get you where you want to be.
Great. And now we're coming to the end. So I still want to try to squeeze in one or two more questions if possible, just because we have a lot of good ones. And again, please reach out to us if you would like, reach out to your advisor, reach out to anyone who sent you the link, and we'll be happy to answer this. So let me just see one of these. So is there a way, and this may be, more of the planning part of it, but so how do we reduce exposure on capital gains expenses when reducing stock concentrations? You mentioned, Jeff specifically said, you're going to eventually have to pay it, and that's true. So what do Sean, Jason, from your guys' perspective, what do you guys look at when trying to minimize, capital gains when reducing the stock?
Yeah, and so Evan, in the custom plans we build out, typically a client has us review all of their account statements and lots for each of the positions in the concentrated stock and see what the overall unrealized gain looks like. And we can use a strategy where, looking at the collar or the gap and cap type of trade, we can implement over certain timeframes. So some of these companies that are the usual suspects, like Apple, Amazon, Google, Microsoft, they've got options markets that typically go out to 2023 at this point. So we can have protection in place in 2021, protection in place in 2022, and protection in place all the way out to 2023, so that you've got downside protection should the economy roll over or tech companies ever actually go down in value, which they don't seem to want to do. You've got the embedded protection in place with a plan that over these different timeframes, you will be selling the stock and diversifying into alternatives or other stock strategies. And you've got the protection in place over different calendar years so that we're getting you into a different tax year for capital gains purposes. And some of our clients say, hey, Evan and Sean, we're comfortable realizing $200,000 in gains for the next 3 years, or whatever that number might be. We customize it to the client with whatever they're most comfortable with. And another part of that gets a little down into the weeds and looking at each of those option strategies, we can actually do advanced tax planning. In some cases, you can close out of these options trades early. We do a lot of this at the end of the year with tax planning for clients, where you close out of the options trade early to potentially realize losses depending upon what's happened. And those losses can be used to offset gains elsewhere or to offset gains in the concentrated stock itself. And those are the conversations Evan and I have with clients throughout the year.
Great. And last question, because I think especially in the last, few months of volatility, especially some around the high flyer stocks, this has been a question that we've been talking with clients about, and I think is really relevant. So I'll read the question is for some of us that have made a lot on Tesla in the last year and now have a large position, but now are seeing a lot of downward volatility, I feel like I lost the time to sell and now it's too low. How should I balance selling off or doing one of your cap strategies where I'm giving up future upside when the prices drop so much already?
Well, hopefully you didn't get into Bitcoin and Dogecoin also. But I mean, look,
no comment.
There's a trade-off. Protection comes at a price. And the more volatile the stock, the more expensive the protection is going to be. Now, that being said, when you sit down and you kind of take a fair look at what's going on with a particular company, maybe it's worth the short-term cost to simply buy a protective put deep out of the money. And in this case, we're talking about fire insurance. We're talking about something that, we're not talking about a 5, 10, 20% decline. We're talking about something systemic that has changed in the stock, something systemic that really makes you go from, I love this company to, I don't really think this is a good idea anymore. We're talking about something like that. And you protect yourself from something like that. And in the meantime, part of being an investor and part of being a successful investor, frankly, is rolling with the punches. And taking advantage of opportunities. Opportunities are always ugly. There is never a pretty opportunity. and just looking at it that way. So yeah, protect yourself, buy some insurance, buy some fire insurance, spend what you're willing to spend on it, with the assumption that, you know, if something really changes as far as your expectations or your perspective of the company, you're going to be protected. And as always, it's, you know, more important than anything is whatever you're doing and whatever you're considering, make sure there is no impact to your standard of living as a result of any of these moves. That's the line. If a decline in Tesla of 30% means you're going to have to sell your house and move into an apartment, you know, that's half the size of your current living spaces, you know, it's time to reconsider a few things. Yeah. And that's really what should be the overreaching question, we'll call it.
Awesome. Well, if guys, we're out of time. Thank you so much. You know, that line about opportunities are always ugly. That was how I proposed to my wife, so that worked for me. So I appreciate that. But ending on a more serious note, thank you for all the time. It's been a very interesting, you know, past year. And thank you for your time, for all your hard work, for the clients who, you know, we have developed relationships with and who have been part of this. Feel free to save our contact info, reach out if you have any questions. And you will see some information coming out to you soon of an upcoming webinar in June, which the date and the topic is yet to be finalized, but it is in the works. So we will get that out to you shortly. And all of the replay of this video, once it goes through compliance, will be up on lidoadvisors.com. Thank you everyone again for your time and your questions and participation. Again, Jason, Jeff, Sean, excellent job. And we hope to see you all soon.